So thinking about investing globally, but not sure exactly where to start? Well, Mark Moreland from Value 3 is here to make the case for going global, beyond Australia, beyond the ASX, and into the world of true compounding growth. And with Tesla results out overnight and global markets shifting fast, Mark will also share why global diversification matters and what he looks for in super compounders, and how everyday investors like you can position for the next decade of growth. A very warm welcome, Mark.
It's great to be here.
From Value 3. Great to have you. Look, I'll be a bit cheeky here.
Yeah.
Are you anti-ASX? I mean,
no, I've been accused of that lately, in fact, because people are used to hearing me talking about Team Invest, which is very much value two, which we call it Buffett-style value investing. And no, I'm not anti it at all. The reason we're more focused on the US now, and we still cover ASX shares as well, is the opportunities are way higher in the US and the values are a lot better as well. Unfortunately, on the ASX at the moment, nearly all the good companies that we like are super expensive, so it's very difficult to buy anything.
So this is finding opportunity, and to do so, you need to diversify.
That can change, you know. So in a year's time, we may be much more interested in the ASX, but at the moment, it's pretty hard.
Mm-hmm.
Yeah.
So let's start with a big one overnight, because I know we'll be talking about Tesla, but Tesla's results were out. What stood out most to you, and how does Tesla rank in terms of that long-term compounding perspective?
Well, Tesla, I think, is probably the most misunderstood company in the tech space. And obviously Musk is very polarising, so a lot of people really got turned off Tesla and their cars when he went in with Trump and Doge and started playing in politics. It didn't play well. There's no question about that. But the underlying business is quite brilliant, and Musk, from my point of view, is by far the best entrepreneur and executor in the world. There's no one who's even close to what he's done. And even though he's underestimated all the time, and basically everybody, all media said he would fail making electric cars, it was a joke. He's now producing over 2 million a year. When he went to space, they said that's a joke. He talked about reusable rockets, that's a joke. No, impossible, no one can ever do that. Basically everything Musk says he's going to do, he achieves it. It just takes longer than he'd hoped. But that's normal, by the way, because when you have entrepreneurs like that who really drive change, they always have to have very, very strong stretch goals and to get their teams working towards doing basically things that are nearly impossible.
So it's no surprise that as a Tesla believer, even in the wake of, you know, what was a pretty poor quarterly results in terms of revenue, that you're still a believer.
Oh, absolutely.
When you have a company such as Tesla that divides people so, you know, so dramatically, does that, you know, change the investment thesis for it?
No. If anything, it's good, because at the moment Tesla is trading at $300 odd. It's lower than, about 30-40% off its high. So, and that's all because of the massive negative positions that all the general media take on it. Basically, whatever he does, they take a critical view of it. They don't, nothing's good. Mm-hmm. And that's great, because what that does is it keeps the share price depressed. And I'm a net buyer, so I'm happy to that continues. So the poor results that came out, I think were understandable. They were expected. I think this morning when I had a look, the share price it was up a little bit, and that's because the market came out with what was expected. However, their energy business was up very strongly. They've now got 70,000 superchargers. There's quite a lot of dimensions to Tesla, and the compute, obviously, with what they're doing, is quite amazing. But at the end of the day, what Tesla is not a car company. That's the fundamental difference. So if you're an analyst, what the analysts will do is they'll say, we can only look at actual businesses and what revenue is to be able to project what something's worth. So they all focus on Tesla's manufacturing car business, but the real game is physical autonomy and full self-driving, and then moving into robotics over the next year and two. And that is going to be revolutionary. I think the robotics side will be at least $12 trillion business. So Tesla at the moment, I think, is incredibly cheap because it's at an inflection point where all this is now coming to bear. And they're the leaders. They're leading in robotics. They're definitely leading in neural net processing and the way they've changed their approach to autonomy, which is physical AI basically. And it's teaching the cars to look at it like a human. So you look at it and you rationalize, what am I looking at? Not trying to, what they used to do was have thousands and thousands of hours of video saying, if a cat comes out, don't hit it. In other words, instructions based on actual vision. what's happened now, and a lot of this is a consequence of the massive compute power that's been released now. So with the large language models, and that's changed everything. So I think Tesla's going to have its ChatGPT moment within a year. Where it could 5x overnight, just about.
And that is when this robotics, when this automation piece comes through.
Yeah.
So full faith in
absolutely.
Mr. Elon Musk.
Yeah.
For those meeting you for the first time, just what is Value 3? What problem, I suppose, are you trying to solve for investors?
Okay, well, I've been investing for about 40 years, and we had Team Invest. I was involved. I was the co-founder of Team Invest. We had for 16 years, which we've been with you guys for all that time back in the old days too. That was Value 2, we classes, which is very much Warren Buffett style value investing, where you're looking for long-term stable businesses that are very predictable. And that's all fine, and that still works. But what's happened, of course, is over the last decade particularly, and even more than that, the market has changed to a digital economy. And if you look at the US, for instance, the S&P 500, it's really the S&P 493 and then the Magnificent Seven. And if you actually compare the results, the bulk of the returns are coming out of 7 companies. That's been for the last 7 years. So at the moment, the average for the Magnificent Seven for 10 years has been 29% a year. That's what the average returns have been, which is quite incredible. And if you then, with them out of the S&P, your average returns are about 9. So the market's getting 9, they're getting 29. So, and the reason is, those businesses now are capital light, and they typically have very, very strong leverage on the returns they get on dollars invested, and they're very, very low capex, generally. And that's changing a bit now with massive compute purchases, but they have been very low capex up till now. So what happens is, the other problem is, and the why we've changed this, is once those businesses are mature, a typical value investor can buy them. Like, for instance, Nvidia or Amazon or Apple have all been around for a long time, so they work on traditional metrics. But when you look at the new higher growth companies that are going to be the next generation of those companies over the next 10 years, which are very much in the AI and digital space, they are much harder to value. And they tend to get, the share prices tend to rocket up long before they're profitable. But you can value them properly. And what we're doing is we're changing how we review the accounts. So we renormalise all the accounts to work out what's really going on. Because gap accounting is a disaster now for investors. Even Buffett said it. The gap accounting is totally useless from an investor point of view.
Well, I think this is relevant for our audience. And just a reminder as well to those of you out there that we are taking live questions. So if you have a question for Mark, feel free to go to the side of your screen and you can put it in there. And we've had a couple submitted ahead of time, so we'll get to those in just a minute. But I think this is relevant for our audience because you have to ever evolve as an investor. So you've gone from value 1, value 2, value 3, and you alluded to it earlier that you will change if the circumstances change.
That's right. So we haven't abandoned Buffett thinking at all. So we still, all of Buffett's principles are still relevant. And a lot of the things about moats, we've changed our view a bit on moats. For instance, moats used to be very static. We see them as much more transient now, and we talk about powers. So it's the same as a moat, but you look at it as being not a reason that you can sit on your bum and just increase your prices, which is what it used to be. If you look at even Buffett used to say that.
So how do you look at moats now?
So now you look at them and say, we're in a much more dynamic market. So competition comes in much faster. Digital economies, things can change much quicker. So you look at are they growing their moats? So are they getting, is their competitive advantage becoming much stronger or weaker? So it's a transition approach, the way we look at it. But there's still moats. So really what we're doing is using everything we can that's reliable, and then we've adapted it to be able to adjust for the digital economy. So we can invest in these companies earlier.
Yeah. So you focus on identifying these super compounders. Primary hunting ground is that. Tesla is a perfect example in your view of that. So what are the qualities that you look for when it comes to these super compounders?
Well, first is management. Interestingly, we've always been very, very strong on founder-led companies, and there's a lot of evidence to prove that overall founder-led companies outperform hired guns anyway. But if you look at Apple, Microsoft, all of those companies, NVIDIA, are all founder-led. And now some of them, the founders have gone, like Apple, Steve Jobs. And remember, they kicked Steve Jobs out. Apple nearly went broke. They bought him back, and then he turned it back into a fantastic company, then unfortunately died. It just shows you how significant having the right founder is. So it's like the same with Musk with Tesla. He is Tesla. You can't replace him. So when there was talk about, Musk should be kicked out and we get some adults in the room, it'd be the end of the company. It would just be a matter of time if that happened.
Okay.
So very important about management. We're looking for very strong, large markets where you have a large addressable market, and with companies that are clearly showing market fit profitably. So they don't necessarily have to be profitable, although most of the ones we invest in are. We will invest in companies now pre-profit, but they have to have very, very strong revenue growth and very consistent, and demonstrating that their operating costs aren't rising at anywhere near the same rate as their revenue is. So in other words, you can predict that they are going to be a major player over time.
Look, I'm going to, before we move on from Tesla, there's been a question come in from David. Thank you, David. Mark, he says, what range would you consider Tesla a buy today? So what are you willing to pay?
To buy now.
Right.
Yeah. I think it's one of the things. Tesla is volatile, and it will continue to be, but it'll be volatile in an upward trajectory. And the risk you run is if you say, well, I buy it at 250 or something like that, and then you may never get there, or it might. The point is, it doesn't really matter. When you're in a company that can really do it like a 10x or better, which I believe it will, it doesn't really matter. Whether you pay 350 or 400, it's not going to make any difference.
Okay.
But if you wait, you might not get it for that because it could run away a lot earlier. Musk is talking about releasing his Model 3 Optimus robot, which is a new version. Apparently, it's going to be mind-blowing. And just that alone, if they come and dazzle everybody, there's a lot of analysts now who are starting to look at it. Mm-hmm. They haven't so far. They've given zero value to what is going to be a fundamental change in everything in the economy with robotics.
We'll segue into a couple other questions, but first from me, besides Tesla, are there any other on your radar, any other companies in the United States that are potential category killers over the next 5 to 10 years?
There's a lot, but there's not that many that are big, large companies. There's lots of smaller companies within like for instance, NVIDIA is obviously another clear winner, and it's my largest position.
Yeah.
And NVIDIA is a spectacular company, and I think that'll be. My prediction is it'll be at least 10 trillion by the end of the decade. Wow. It's already 4.
Yeah.
So I think it's easy for it to get to 10. So that's a buy now as well. However, within their stack, there's quite a few companies that are critical component suppliers within that. I'll give you one example. It's a company called ON Semiconductor, and they do basically, Tesla's a big client of theirs as well. They do the optical brains, so it's the chips and the cameras and how they all operate. So they're going to be massive in compute, but they're also a major supplier to NVIDIA. But they're quite a small company and not on a high PE, so it's a good example of one.
Now, Mark, this question came in ahead of this event, so thank you, Mark, who asks, has Google peaked with the advent of AI?
It's a very, very good question, and I've been toing and froing it a bit on the argument. I've read quite a few arguments on that both ways. Look, I just read Google's report this morning that came out yesterday, and it's a fantastic report. Their growth's strong, cloud, their growth in advertising as well. So there's no sign of AI hurting them yet. Now, having said that, ChatGPT obviously has had incredible uptake. Google's growth rate on search has slowed, but it hasn't gone back. And they're making about 90% of their revenue from search. So it's fundamental to Google's business. So obviously, if AI can if they can take people off using Google. So I don't use Google anymore. Mm-hmm. I tend not to, by the way. I just use Perplexity or Claude or whichever what I'm using. I use several of them. Mm-hmm. So I do that. It's going to be harder for Google to monetize it, of course, because at the moment they're selling. You put your ad in for your product, and they serve you your website. That goes when you start looking, when you get answers to your questions. But Google's also got very, very strong LLMs. Their Gemini 3 is brilliant. It's the leader in graphics and so on as well. So they've got massive assets in Google and plenty of money and so on, and they recognise the challenge. So I read an internal memo a couple of years ago where one of the executives said, our moat's gone, we have no moat. Talking about AI coming in, that's as a threat to the business. And that's not true, because they have a massive moat, and even now with the success of LLMs, it hasn't hurt them yet at all.
Large language models for anybody playing at home. And we have had a question come in from Philip, and I think you've sort of touched upon it, but just your view on AI, Mark. You believe it's the future?
Absolutely, and I think we're going to get to AI superintelligence soon. I don't know when, but it's. I think
So what do you consider superintelligence, or explain it for our audience?
There's AGI. It's classed as AGI, which is a general intelligence, which is and by the way, there's no really clear definitions on these things because it's depending on who you ask.
Yeah.
Superintelligence can be more defined rather than general intelligence, meaning that it's better than the best humans in every subject. At the moment, they are better than humans in certain things, but not everything. I think it's inevitable that we'll get there and fairly quickly. And what we don't know, and I think we can assume, is that it's just going to magnify the advances in material science, medicine, everything. I mean, it's very, very exciting.
Now, you've mentioned that the US remains your hunting ground primarily for stocks.
Yep.
Now, there's so much noise around policy there. There's so much noise around the US administration. Do you incorporate macro at all into your investing process?
I'm macro aware, but it doesn't often make a difference to your investing, and particularly politics. And I've seen a study on the US. If you look at the US through all the different presidencies, whether it's Democrats or Republicans all the way back, it's made very little difference to how the markets have performed. There's things that come in like COVID. It wouldn't matter whether it was Republicans or Democrats. So there's been a few things like that. Same with the GFC. That wouldn't have mattered. So what I'm saying is, apart from all the noise and all the focus of the media, it really doesn't make much difference. What you're looking for are the companies that are operating really well, are growing, making profits and giving returns to shareholders. And that seems to happen anyway because the US is the number one entrepreneurial market in the world, without a doubt.
It is, but China is nipping at its heels in terms of AI. Yep. Is that a risk?
I think it's great. I think it's the sort of competition they need. I mean, when DeepSeek came out, it was a total shock. It was a big wake-up, and that has really revved up what's going on in the US now. So I think having a very strong competitor in China at an economic level is fantastic. Let's just hope they don't become a military competitor.
Paul's just asking for some clarification. Thanks for all the questions coming in. Saying, is that ON Semiconductor, are they providing any equipment or any assistance to Tesla?
Yes.
Yeah?
Yeah, they are.
Okay.
They're a key supplier to Tesla.
Good.
So the thing is, if robotaxis roll out, Tesla's doing about 2 million cars a year at the moment. If they do with autonomous driving and robotaxis, who knows what that's going to be? It's going to be a lot more.
Another one from Anne. Hello, Mark. What do you think of U.S. utility providers such as American Towers Corp and/or data center service providers such as Vertiv?
Vertiv's interesting. They do cooling and a whole range of components for NVIDIA as well.
So I guess the question might be, if you believe so much in AI, are you primarily gaining exposure through these sort of picks and shovels, through the innovators, or do you also look toward that data center thematic that will fuel the AI?
The data center one is difficult in that there's a bit of a bubble in that, particularly in Australia. Our data centers are ridiculously priced for what they can deliver. But in the US, there's different aspects to data centers because there's the biggest issue at the moment is power. So if you can get the electricity supplies, that's tending to dictate where you build them and so on. And there'll be money to be made in that, but that's more difficult. At the moment, for me, the easiest, most reliable money is in the semiconductor area at the moment and software. And I think cybersecurity is going to be it is big already, but that's going to continue to get bigger and bigger and bigger, like Cloudflare and CloudStrike and people like that.
Look, I know we still do have some questions coming in. However, in the interest of time, perhaps now we talk about, if investors want to learn more about your investment process, follow along with your portfolio thinking. How can they get access to your insights?
Well, at the moment, we don't have paid membership. So if you go to value3.com, you can subscribe to my Mark's Insider newsletter, which I do fortnightly. And I've done about 15 so far, and they're all deep dives on good investments. So it's very good value because it's complimentary.
Value 3, I would expect nothing less.
I do a fortnight. I know. Then for those people, I also do a fortnightly webinar Q&A.
Okay, so they sign up, complimentary access to Value 3 Insider, so they get deep dives into company analysis. Do they get any sort of frameworks that they can apply themselves?
They will. At the moment, we're going to be launching some different membership options soon. Yeah. So, but at the moment, that's the main connection, and I promise there's a lot of value in that. So.
And now it sounds like to you is just a really exciting time to be an investor.
Oh, it's
a global investor.
I think the next decade is going to be the best returns in history because we'll look back. And so what you need to do is think critically about things and not just take what the media says. So when everyone's negative on it, and another quick example of that was in 23, Meta dropped down to about a 10 PE, so share price went down, I think it was about 45%, and that was because everybody in the media, all the media were negative on Zuckerberg about the metaverse, blah, 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 and what he was spending, and said he was crazy. It bottomed there, and since that it's up 700%.
Yeah, you're right.
And I was really annoyed at myself at the time because I actually got worn down by all the negative arguments and I didn't buy it, whereas it was really dumb. So I won't do that again.
All right.
So I think the more negativity out there and the more short seller reports, the better, quite frankly.